In Canada, capital gains tax is a tax levied on the profit or increase in value that arises from the sale or disposition of certain types of assets, known as capital property. Capital gains can include gains from the sale of real estate, stocks, bonds, mutual funds, and other investment assets. Here are some key points about capital gains tax in Canada. Inclusion rate. Currently, 50% of the capital gain is included in an individual's taxable income, meaning that only half of the gain is subject to tax. This results in a lower tax rate for capital gains compared to other forms of income, like employment income. Taxable capital gain calculation. The taxable capital gain is calculated by subtracting the original cost or adjusted cost base, ACB, of the property from the proceeds of disposition. The ACB includes the original cost of the property plus any additional expenses incurred during ownership, such as commissions or fees. Tax rates. Capital gains are taxed at an individual's marginal tax rate. In Canada, the federal tax rates for capital gains range from 0% to 26.76% for individuals, depending on their income level. Additionally, individuals may also be subject to provincial and territorial capital gains taxes, which vary across different jurisdictions. Principal residence exemption. A principal residence is generally exempt from capital gains tax in Canada. If an individual sells their principal residence, the gain realized is not subject to tax. However, it is important to meet certain eligibility criteria and report the sale on the individual's tax return, even if it is exempt. Capital losses. Capital losses can be used to offset capital gains. If an individual sells a capital property at a loss, the capital loss can be used to reduce any capital gains in the same tax year or carried forward to offset future capital gains. There are rules and restrictions regarding the utilization of capital losses, so it is important to consult with a tax professional or refer to the Canada Revenue Agency (CRA) guidelines. Small business deduction and capital gains. It's worth mentioning that the small business deduction rate of 9% mentioned earlier can also apply to eligible gains from the sale of qualified small business corporation shares. This deduction provides a reduced tax rate for capital gains derived from such shares, subject to specific requirements. Timing of taxation. Capital gains are generally taxable in the year that the disposition of the property occurs. It's important to note that the timing of the sale or disposition can impact the year in which the capital gain is recognized for tax purposes. For example, if a sale occurs near the end of the year, it might be advantageous to defer the recognition of the gain to the following year to delay the tax liability. Capital gains and registered accounts. Gains from the sale of assets held in registered accounts such as registered retirement savings plans (RRSPs) or tax-free savings accounts (TFSAs) are generally exempt from capital gains tax. However, keep in mind that there are contribution limits and other restrictions on these types of accounts. Capital dividends. For Canadian-controlled private corporations (CCPCs), capital gains generated from the sale of certain investments may be eligible for a capital dividend. This allows the corporation to distribute the after-tax capital gain to its shareholders as a tax-free dividend. The availability and calculation of capital dividends are subject to specific rules set out by the Canada Revenue Agency (CRA). Non-residents and capital gains tax. Non-residents of Canada are generally subject to capital gains tax on the sale of taxable Canadian property. However, Canada has entered into tax treaties with various countries to prevent double taxation and provide relief or exemptions for certain capital gains. Reporting requirements. Individuals are required to report capital gains on their Canadian income tax return. The Canada Revenue Agency (CRA) provides Schedule 3, capital gains or losses, which individuals must complete and submit along with their tax return. Inflation and Adjusted Cost Base (ACB). The Adjusted Cost Base (ACB) is the original cost of the property plus any eligible expenses incurred during ownership. In Canada, the ACB is generally adjusted for inflation using the Consumer Price Index (CPI). This ensures that the capital gain is based on the real increase in value, rather than just the effect of inflation. The Canada Revenue Agency (CRA) provides guidelines on how to calculate the ACB and adjust it for inflation. Interplay with other deductions and credits. capital gains tax can interact with other deductions and credits in personal income tax returns. For example, the inclusion of capital gains in taxable income may affect the eligibility for certain income-tested benefits or credits, such as the Canada Child Benefit or the Goods and Services Tax (GST) credit. It's important to consider the overall tax picture when planning for capital gains and consult with a tax professional if needed. Capital gains reserves. In certain situations, individuals may be able to defer the recognition of capital gains and spread the tax liability over multiple years. This is done by utilizing the capital gains reserve mechanism. For example, if the sale of a business or property includes a vendor take-back mortgage, the capital gains can be reported and taxes paid over a period of time based on the repayment schedule. Foreign investments. Individuals who hold investments in foreign countries may also be subject to capital gains tax in Canada upon the sale of those assets. The proceeds and gains from the sale of foreign investments need to be reported on the individual's tax return, and specific rules apply to determine the tax treatment of these gains. Gifts of appreciated property. When an individual donates appreciated property to a registered charity or other qualified donee, there may be tax advantages available. In such cases, a portion of the capital gain may be eligible for an enhanced charitable donation tax credit, which can help offset the tax liability on the gain. It's important to keep in mind that this information is a general overview of capital gains tax in Canada and that specific circumstances or unique situations may require further analysis and professional advice. Airzol is a leading provider of comprehensive tax solutions. With our team of experienced professionals and cutting-edge technology, we offer efficient and accurate tax services to individuals and businesses alike. From tax planning and preparation to IRS issue resolution, we handle all aspects of taxes with precision and expertise. Our commitment to delivering personalized solutions tailored to each client's unique needs sets us apart. Contact us today at +1 647 232 7909 and discover how Airzol can streamline your tax process and help you achieve your financial goals.